From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Well, hello. Good Monday to you. I'm Nadine Blaney, and from all of the team here at ausbiz, thanks for joining us. So I'll timestamp this. We're just past 4 p.m. in Sydney. If you're listening to us on podcast form, you can catch up with all of our interviews throughout the day on ausbiz.com.au. But yeah, just past 4, and that means that the COB Australia Index has closed higher, I'm happy to say, for the day, up by about 0.5%, although we did see some selling post 2 p.m. into the close. But it was a pretty solid performance right from the get-go. You know that we had the Dow closing at a record high in New York on Friday. It's still expectations for the Fed to be able to go ahead and continue to cut rates from here on in, at least a couple more times this year. And we do hear from Federal Reserve Chair Jerome Powell tonight. But it was really that stimulus from China. It came last week, as you well know. I mean, we saw that massive rotation from the banks into the resources names already. But it was backed up on Sunday by news that China will do more to support its beleaguered property sector, and that includes making sure that lenders cut rates by the end of October. I had a really great chat with Raymond Chan from Morgans earlier today, and he put something on my radar that I hadn't really been aware of before, but he said it was actually back in August that Chinese authorities changed the rules to allow people to refinance their mortgages, something that had not been previously allowed. So he sees that as really big and important stimulus to get the Chinese consumer spending as well. So I had so many conversations today as we continued to think about this rotation from some of those sectors that have been high flyers into some of those names that have been pretty beaten up because they had that sentiment soured around China. And today from China, just to continue to make the connection, we did have PMIs released, and they were disappointing, particularly the private read into manufacturing. So that again raises the specter of, perhaps even more stimulus coming from China as authorities there try to, in Raymond's view, put the focus back on growth. They want to hit that 5% growth target. And so that could, result in even more buying in some of these major miners, because it was really the mining story today. Iron ore was up, copper was up, coal was higher. And if you go to our website, ausbiz.com.au, it's Raymond Chan, it was John Mills from Morningstar, it was Tom Robinson from Paradise. I'm trying to remember them all. That was just when I was on air. Naming companies, naming miners, naming other companies that they reckon could now be benefiting from China's push and, let's say, bringing the punch bowl to the party. All right, with that in mind, here is a run through the sectors of the day. And solid gains for the likes of BHP, 2.6% higher by the end of the session. Fortescue up by 3%. Mineral Resources putting on 4.9%. So some of the shorts in many of the materials names are getting washed out as well. Energy, though, energy was also a strong sector. I was just looking at some photos from that hurricane that went through the U.S. Gulf Coast states and actually impacted as far inland as the Appalachians. So it shut down some production in the U.S. Gulf of Mexico. However, also keeping, as I said in the previous hour, a very wary eye on what's going on in the Middle East. Of course, we did have the killing of the Hezbollah leader, Syed Hassan Nasrallah, and that happened in Lebanon. We've got reports that there were other Hamas leaders killed in Beirut. There is speculation that Israel could be looking to launch some sort of a ground offensive into Lebanon. Will Iran continue to remain out of this conflict that's been going on for nearly a year now? So far, it has shown that it's not jumping in to the fray, head first. But I was reading some analysis from RBC today, saying that the oil market will likely look past the escalation for now, given there's been no major physical supply disruption, and that Iran has not had the appetite to enter the conflict so far. But this really stood out to me. RBC analyst, saying it's extremely difficult to see where this regional conflict is headed and whether this is the beginning of the end or the end of the beginning. Anyways, the sad news sometimes results in, price of oil and the energy sector doing really well today. And then the banks today. So we saw money coming out of the telcos, coming out of the utility space, healthcare names as well. But not so for NAB and Commonwealth Bank. CBA, while we did see more of a mixed picture in the financials by the end of the session, still positive for NAB and CBA. Liontown Resources did all right today, didn't it? Up by close to 4% after completing its first shipment of spodumene concentrate to China and starting spot sales from its operations in WA. Sinlay Milk, no volume going through here really, but it did report a net loss of 182 million Kiwi dollars. Pacific Smiles has knocked back that Genesis Capital all-cash takeover bid, telling shareholders to take no action and also saying that some of its key backers like MI Financial intend to vote against the deal. And we saw Fletcher Building successfully raised some cash, but also had a broker upgrade coming through from Citi. Of course, it's been a bit beleaguered lately as well, but finished the day up by 5.5%. The Australian dollar hit a 19-month top. The ASX hit that all-time high. It's just all happening. We've got iron ore futures at nearly 3-month highs on that fresh property stimulus coming through in China. So what does Scott Phillips from the Motley Fool make of it all? He joins me now. Scott, hi, welcome. Good day on market.
Good day.
This China
very
stimulus
good
story really seems to have legs this time around.
Man, doesn't it? I'll tell you what, you've already said this, but you've had some great conversation on ausbiz today already, so I'll try to keep the tone up because there is so much going on. And this is, look, for iron ore specifically, resources more generally, and then the economy most generally, I suppose. A stimulated China is really good news. Add that to the US rate cuts, which feel like a million years ago already, but they're, less than 2 weeks ago. And we've really got the global story continuing to push on. Iron ore price up, of course. There is a lot going on when it comes to that macro story. And probably just at the right time, too. We know the issues that the Australian economy is having. We're due to get retail sales out this week, which tells us how the consumer's spending. Unemployment remains pretty good. We're still adding jobs. So, yeah, it's a really, really important juncture for the global economy, and then obviously for us here at home. It's all about us, but the local pressures, the overseas hopefully stimulus should offset each other with any luck, and it might just get us out of jail.
Yeah, well, let's hope so. One thing that it will do, because you mentioned the iron ore price. I mean, look, who knows if it will stay at these levels or even above 100 US per ton for very long. I mean, UBS, for one, says no, it won't. But iron ore has been the gift that keeps on giving for this federal budget. And we had confirmation today that we'll have the second budget surplus in a row. CBA, for one, is saying that this is a good outcome. This is welcome, that it really stands Australia apart from a lot of our global peers. How do we read this as investors, Scott?
So first thing I should say is that Donald Horne, that the ghost of the lucky country, continues to, I won't say haunt, whatever the opposite is, the Australian economy, because yet again, we're getting saved by resources. I can't count the number of times that we've had that as part of what's going on. So again, as you say, good for the budget. Look, a couple of things going on, I suppose. Look, for investors, literally, obviously, we already know this anyway, but the cash coming into the budget, the government coffers is frankly because of iron ore profits, right? So if you're in BHP, Rio, Fortescue, and I own Fortescue shares, you're probably in a pretty good place. Now, no one expects the price to stay this high for a very long time, but for now, it's good. And we just talked about the stimulus. So as you say, who knows how long this goes for, where it ends, at what price it ends. There's a lot going on. I think for investors, it really comes down to a couple of things. Firstly, it does mean the Australian economy is a little bit better than it otherwise might be. It's only a small amount, the increase in the budget balance, but it's very welcome, as you say. It does give the government some firepower should it be needed. Of course, the RBA also, frankly, with rates already being kept this high while others are cutting, there is lots of latent firepower. The risk, of course, is the inflation story, and that still remains, I guess, the issue. The question for Australian investors, particularly if you think about the businesses you own that do or don't have pricing power, how long does inflation remain high? And it's one of those double-edged swords, right? If you're paying a mortgage, you want your mortgage rates cut. If you if you're buying companies, you want to make sure if they've got debt, that goes down. Of course, we know that lower interest rates mean higher asset prices, all things being equal. So you've got this really interesting trade-off right now. The budget itself doesn't directly impact, but it does talk about what's happening in the economy and where we go next. We should say, by the way, I think it's a $40 billion deficit expected in a couple of years' time. So this is, even on the government's own numbers, supposed to be the last surplus as far as the eye can see. So we are kind of back in stimulus territory, particularly if the iron ore price falls, particularly if unemployment rises. The personal tax take, I don't think it's ever been higher. So you've got that spending question as well, notwithstanding the stage 3 tax cuts, which haven't yet had a full year of impact. So lots and lots of moving parts. Net, better than a deficit, but we have to wait and see what it means for the broader economy. It's really those component parts of what created the surplus rather than the surplus itself that investors need to think about.
Yeah, it was on the spending side, some of which were temporary. Don't forget we've got an election coming next year. So
exactly. Are you saying handouts, Nadine? Are you saying government spending? Is that what I'm hearing?
Yeah. Look, I don't want to show my age and my cynicism at this stage because we've got a positive day on market.
Fair.
Maybe my cynicism will come through again. Oh, sorry. But Adam Dawes from Shaw and Partners, I was having a chat with him. I don't think he'd mind me saying because it's out there on the public record. But he put some of his own money into Star Entertainment. Would you do the same? He said their parking lot is worth more than the NTA right now.
So this is the thing, right? And it kind of comes. This is almost pretty binary, right? If it survives, then he's right. I mean, there are assets that are worth more. The problem is, of course, the NTA is more than anything if the business goes to the wall. We still have to work out whether or not it has a license. We have to work out how it pays back that debt. The original debt facility has basically been capped at the current level. It was paid down and new debt issued. We can only assume from that that the new terms are much more onerous. Otherwise, you typically extend the current one, right? So the banks have said, no, we're ring-fencing that. The new debt's coming with brand new terms and conditions. Guess what it's going to look like? So I don't know. I'm not sure. I wouldn't be investing in Star just yet personally. Maybe I don't have the risk appetite that Adam's got. He's not necessarily wrong if it works out, but I do think it's very unlikely that we get a modest outcome here. It's either a great outcome or probably a terrible outcome. There's not much in between. Not a bad bet. I think if you had a dozen stars, you'd probably make money overall because it's so stupidly cheap given the value of the assets. But doesn't mean this one necessarily is going to work out. I hope it does for Adam's sake, and if he does, he can buy the beers. But it's going to be an interesting one to watch. Look, the debt there is still it's really, really onerous. It's an absolute millstone around their neck. The banks are not letting off the pressure here. They're giving enough. It's the old line. Owe the bank of $1,000, you've got a problem. Oh, $100 million, they've got a problem. So the banks are extending loans just to try and salvage something. So Star can trade this one through. The casino regulator in New South Wales, that's the big one to watch, because if that goes down, it may well trigger the covenants. Frankly, we don't yet know what's behind those things, but it remains to be seen whether or not we can get out of this one alive.
Yeah, got it. So Scott, are you looking to trim anywhere? Are you looking to take profits? I know you're a long-term investor, but it's awfully tempting, I would imagine, in some cases, given where the ASX is sitting near all-time highs.
Yeah, no, you're right. Look, I do think I'm a long-term investor, mate, and I think now is a really good time to make sure you understand the quality of what you own. Because if you bought some stuff that was really cheap and now it's kind of moderately expensive or actually just completely expensive and doesn't have the growth left or the quality business that you think you bought, these are the ones you actually want to sell. You want to be really, really careful. You don't mix up your investment theses. So almost all of my investing is super long-term, looking 5 or 10 years out. I want these things to grow and compound forever. That's the perfect world. But some of you kind of get up there and go, oh dear, this is getting a little bit pricey. And there's, quite frankly, there's a few of them around. I haven't made any decisions just yet. We're due to sit down with the portfolio on the scorecard this week and to see what we've got left and what needs to go. But yes, you're absolutely right, Matt. We're definitely closely at some of these. They've run very, very nicely. We're always happy to have money, but at some point you're going to look at it and say, even as a long-term investor, if I'm being offered a stupidly great price to sell, then balance of probabilities, you want to take the money. So yeah, very slowly. I have one of my favorite sayings, to buy and even slower to sell. Again, you let the growth do its thing, you let quality do its thing, you let management do its thing. But yeah, when you start to get to some of those, you look around and go, wow, this has been a very, very nice run. There's some very high PEs at the moment, justified not by earnings growth, but by sentiment. Justified, but if it's not, you want to be careful.
Got it. Scott Phillips, nice to have a chance to speak with you again. Thank you.
Always fun. Thanks,
Take care. Scott Phillips there joining us from the Motley Fool. Okay, Star Entertainment, it will divide the market. But today, the stock of the day was Liontown Resources. So we spoke with David Layden from Ord Minnett and Jonathan Takadina from NPC Markets.
for me, it's a buy, and I'm calling a bottom on that lithium sector.
Is this your preferred play?
I think PLS is a better play though. Like that's actually reacted well. But the thing is, the fact that Liontown had its first shipment tells me that there could be a better reward play here. So if you're going for a more blue chip name, I would probably stick with Pilbara. But I think there's going to be more juice in the Liontown trade.
And I think that at 81 cents, it's probably a reasonable value. We've got an accumulate recommendation on Liontown.
All right, I'm calling that a buy then, a double buy. David, same question though. Is it your preferred play, or you perhaps preference Pilbara?
Yeah, actually, at the moment we've got a hold on Pilbara, so we do have a slight preference towards Liontown, and I've also liked Arcadium Lithium for a while, but probably at the moment, given that Liontown is now shipping, that would be our preferred play.
So that was a double buy for Liontown. I think that was pretty clear this time around. I do know there were 3 other double buys on that program today. It's the call, and you can find it on our website, ausbiz.com.au. If you just go to the top and you go to series, it's there, or scroll down on the website. I hope you know how to use the website anyways. 3 other double buys from those guests. I don't know what that says about sentiment out there, but sometimes you get none. All right, let's get to some of these market leaders and laggards. And these, of course, are being done by percentage change. So this is not market cap, and that is a very outsized move coming through from Core Lithium. Let me just see if I can see any news. Star Entertainment that we were just talking about, dividing Scott Phillips from the Motley Fool and Adam Dawes from Shawn Partners, who added some to his own portfolio today. We've got, it's funny, I'm not seeing Core Lithium. Anyways, Sayona Mining, Karoon Energy doing well. It's got its rigs back up and going in the US Gulf of Mexico. And Tabcorp, which is up by 6.5%. So some solid performances coming through there. Some of the laggards, though, again, by percentage change. Deep Yellow, Genesis Minerals, Vault Minerals, Breville Group, and Nine Entertainment. Nine is down by 3%. It's put out the notice from its annual general meeting, but I can't see anything else really on that, although we did see substantial holding from Perpetual changed last week. Some of the small to mid-cap space, look no further than BrainChip, Core Lithium, EZZ Life Sciences, and Sayona Mining, flipping the page. And we've got some of these smaller kind of, miners and such around. And Webjet, so it, of course, has split its business. So I would dare say that it's something to do with that. And I'm actually not seeing that on my my screen. So we'll move on from there. Okay, now tonight, this is where it gets a bit interesting. We get the Chicago PMI, likely to show that manufacturing remains weak. We get the Dallas Fed survey, also out tonight, but we have the FOMC chair, Jerome Powell, speaking at the National Association for Business Economics. So he will be asked about the path for interest rate cuts. Of course, he'll say it's data dependent, but we'll look for nuance coming from any of his commentary. We'll bring it to you tomorrow. Tomorrow what's happening is we do get retail sales here locally. We get the CoreLogic Home Value Index, and we get building approvals, for August. All right, now we have seen the curtain come down. On this session, we've got the S&P ASX 200 still in positive territory, up by 0.7%. 8,270 is where it will end, 15 points off the highs of the day, and in fact, lifetime highs for this market. We have had a bit of news coming out. We've had the UK economy growing by a slower than expected 0.5% in the second quarter. And yes, we will be watching that. We will be watching the Middle East, and we'll be watching for continued commentary from China, as well as any fallout from that hurricane that's happening in the United States. So lots to keep our eyes on. And we're also just getting news as well that Japan's incoming Prime Minister Ishiba has set October 27th as the date for a snap election. So a little bit of political uncertainty in Japan as well. So stocks diving As we've been watching some of that unfold throughout the day today, the Nikkei off by 4.8%. It was wonderful to be here with you today. I hope to see you tomorrow. We're live from 9:45.